Welcome to XRP Cypher, where we decode how the global financial system is actually being rebuilt.
This podcast isn't about price predictions or speculation. It's about infrastructure, liquidity, and how money moves behind the scenes.
Each episode breaks down XRP, the XRP ledger, Ripple, and the regulatory and financial mechanics shaping the next generation of settlement.
If you want clear explanations without hype and a long-term view of where global finance is heading, you're in the right place.
This is XRP Cypher.
Welcome, everyone, to today's deep dive. Our mission today is, well, it's simple but massive. We are exploring how money actually moves.
Right, the real underlying mechanic.
Exactly. If you are listening to this, you are getting a shortcut to understanding the hidden plumbing of global finance. We are going to look past the ticker symbols, ignore the retail trading apps entirely, and look directly at the pipes.
Because that is where the real shift is happening right now.
Yeah, and to do that, we have a stack of incredible sources today. We are looking at institutional blueprints on digital asset trading, incredibly dense regulatory frameworks straight from the Bank for International Settlements, the BIS, and some major recent announcements from Ripple, Binomial, Securitize, and SBI Holdings.
What's really fascinating here is the story these sources tell when you piece them all together. The global financial system is currently undergoing this massive, completely silent overhaul. Right now, as we speak, trillions of dollars are trapped in outdated systems.
Trillions just sitting there.
Just locked up, literally just to keep the gears of global trade turning. But the race is officially on to unlock that capital, and the tools being used aren't what most people think. We are talking about blockchain, yes, but specifically stablecoins, digital prime brokerage models, and sweeping regulatory mandates that are forcing the hands of the world's biggest banks.
Okay, let's unpack this legacy banking system first, because to understand the fix, you have to understand the broken plumbing. I am talking about the Nostro and Vostro account system.
Right, the correspondent banking mess.
Yeah, basically, if a bank in the U.S. wants to facilitate a cross-border payment to a bank in Japan, they can't just send an email. If it is 3 in the morning in Tokyo, you can't just wire funds and expect it to clear immediately.
You literally have to hold pre-funded accounts.
Exactly. Nostro and Vostro accounts. In different currencies, in different time zones, banks are parking their own capital in dormant accounts globally, just in case a client needs to make a transaction. It traps trillions of dollars of liquidity just sitting there doing nothing.
It is a system built entirely on pre-funding, which is incredibly capital intensive. And you would think that early crypto markets would have fixed this.
You would think so.
But if you look at the blueprint for institutional digital assets trading source we are reviewing today, it points out that early crypto didn't actually fix the plumbing at all. It just built a different, equally flawed system.
The exchange-centric model.
Right. We call it the exchange-centric digital asset model. Retail crypto exchanges operate as vertically integrated silos. They took execution, custody, clearing, and credit, and they mashed them all into one single platform.
Which is wild when you think about it.
It is. Imagine the New York Stock Exchange also acting as your personal bank, your broker, and the clearinghouse all at once. That is a massive concentration of risk.
Which sounds incredibly convenient if you are a day trader swiping on your phone, but for a financial institution, it is a nightmare.
It is a systemic fragility waiting to happen. Because these exchanges are silos, they create what the blueprint calls interdependent settlement chains. Let's say a market maker needs to settle trades across 3 different exchanges. Because there is no central clearinghouse connecting them, they physically have to move assets intraday between these venues.
Right, they have to withdraw from exchange A to deposit into exchange B.
Exactly. And if asset mobility gets constrained, say, a blockchain network gets congested or an exchange suddenly pauses withdrawals, that entire chain breaks. The source explicitly points to the collapses of FTX and Celsius to illustrate what happens when this goes wrong.
Oh, yeah, the free capital loophole.
Yes, these venues were using client collateral as interest-free working capital. Instead of proper settlement and margin management, they socialized their losses through cascading auto-liquidations.
Let me put this in perspective for you, the listener. Imagine trying to buy a house, but your mortgage bank, your real estate agent, the home inspector, and the escrow company are all the exact same person.
That is a terrifying thought.
Right. And while you're waiting to close, this person is secretly using your down payment to fund other real estate deals for themselves. That is essentially the retail crypto exchange model. Institutions absolutely refuse to play that game.
They cannot and will not expose billions of dollars of client funds to that kind of opaque counterparty risk.
Which brings us to the macro catalyst that is forcing this entire conversation. It's not just that banks want to upgrade their tech stack, they are being mathematically forced to.
And the pressure is coming from the Basel III mandates.
Basel III, this is the global regulatory framework that changes everything. To put this Basel III NSFR rule in plain English, regulators looked at banks parking billions of dollars in dormant Nostro accounts around the world and essentially said, yeah, that's incredibly risky and inefficient. We're going to tax you heavily for being slow.
It is a massive regulatory spick forcing them into the digital age.
So what does this all mean?
Well, to get specific, we need to look at the NSFR, the Net Stable Funding Ratio, detailed in the BIS source material. Basel III requires banks to maintain a stable funding profile over a full one-year horizon.
A full year? That is strict.
The math is very strict. A bank's available stable funding, or ASF, must be greater than or equal to 100% of its required stable funding. Right. In practice, this framework severely penalizes short-term wholesale funding and encumbered assets. If you are tying up assets in those old, slow Nostro accounts, Basel III hits you with massive capital requirements. It forces banks to hold high-quality liquid assets, known as HQLA, to cover their risks.
So the capital drag of the old system is simply no longer affordable.
Exactly. Intraday liquidity risk and pre-funded Nostro accounts are now incredibly expensive to maintain on a balance sheet. Because of Basel III, banks are being mathematically forced to abandon slow, batch-based settlement.
They have no choice.
They have to move toward real-time, digital, neutral asset settlement just to stay profitable. The old way is dead.
So Basel III essentially puts a ticking clock on these banks. They can't afford the old way, but as we just discussed, they refuse to touch the risky retail crypto exchanges. They need a third option.
Right.
And ironically, the blueprint suggests they aren't inventing something new. They are just copying the most robust, battle-tested system on Earth, the foreign exchange market.
Because the FX market trades trillions a day, flawlessly, specifically because it is unbundled.
Here's where it gets really interesting.
Yeah, you don't have vertically integrated silos in FX. In the traditional FX market, you don't trade on an exchange. You use an ECN, an electronic communication network, just to match the trade.
Right.
But the actual credit and margin are handled by prime brokers. And post-trade settlement goes through a massive neutral utility like CLS, which acts as the ultimate referee to make sure both sides get paid.
So the execution, the custody, and the credit are entirely separate.
Completely separate. And crypto is trying to copy that exact separation. That is what the digital asset space is now building, the Digital Prime Brokerage, or DPB, solution.
We see this directly in the source regarding Ripple Prime and their expanded partnership with TJM, an institutional broker. Instead of an institution going out and setting up 50 different accounts on 50 different crypto exchanges.
Navigating a maze of bilateral relationships.
Exactly. Navigating all that, they use a DPB. In a give-up model, it's like having a universal VIP pass. You trade wherever you want, exchange A, exchange B, but at the end of the day, you give up the trade to your prime broker, who settles the whole tab at once.
You only deal with one trusted counterparty, not 50.
Right. You sign a single master agreement, an ISDA with that prime broker, and they centralize the credit and the risk intermediation.
And the capital efficiency this creates is staggering, specifically because of standardized T+1 net settlement.
Yeah.
This is where the trapped capital gets unlocked.
Let's look at the data point from the institutional blueprint on that.
Yeah, in the old gross settlement model, if a client buys 100 Bitcoin on one venue and sells 80 a coin on another, they have to physically move 180 Bitcoin to settle those two trades.
Which is incredibly inefficient.
Very. But with a DPB using net settlement, all of those obligations are aggregated at the end of the day. You only settle the net difference. So instead of moving 180 Bitcoin, only 20 Bitcoin actually moves.
That is an 89% reduction in gross fund movement.
Exactly, 89%.
Wait, let's pause on that 89% number. If a bank is moving billions a day, an 89% reduction in gross fund movements isn't just an operational upgrade. That's billions of dollars in trapped liquidity suddenly freed up to generate yield elsewhere.
That's the true definition of unlocking capital.
And it's not just about freeing up capital, it's about eliminating hidden taxes. The blueprint points out that when you trade on bilateral offshore exchanges, they often embed an 11% default swap rate into their spreads.
11%. That is massive.
That's 7% above the risk-free rate. We're talking about a hidden cost of $192 per $1 million traded every single day.
Right, and at Digital Prime Brokerage, strips away that hidden tax because it separates the credit from the execution, you're actually getting true price discovery.
To make this digital prime brokerage model work at a global scale, though, you need assets that function flawlessly within this new plumbing.
You can't just use legacy fiat.
No. You need pristine collateral, and you need a high-velocity bridge. Let's talk about those assets, starting with RLUSD, Ripple USD.
Yeah, this isn't just another stablecoin. The sources show it is engineered specifically for this institutional prime brokerage environment.
It's regulated by the New York Department of Financial Services. It has surpassed a $1.2 billion market cap, and it was just recognized as an accepted fiat reference token in Abu Dhabi's ADGM.
But to make RLUSD work, you need legal cover.
Right, and I was fascinated by the mention of New York's UCC Article 12 in the sources.
It essentially updates the law to state that for controllable electronic records, like a stablecoin on a blockchain, control equals ownership. That completely flips the script for banks.
It solves a massive headache, doesn't it?
It really does. In the past, holding a digital asset was legally messy. It was seen as a contract claim. If a hedge fund went bankrupt, it wasn't clear who had the legal right to the digital assets pledged as collateral.
So it was just tied up in court.
Yes, exactly. UCC Article 12 legally transforms stablecoins from ambiguous claims into pristine daily operating collateral. A prime broker can safely lend against RLUSD because the law clearly states that whoever has cryptographic control of the asset owns it.
It legally perfects the security interest.
Perfectly said.
And we are already seeing massive institutional use cases built on this legal foundation. Securitize just announced a smart contract integration allowing holders of BlackRock's BOIDL fund and VanEck's VBill tokenized treasury funds to instantly, 247, exchange their shares for RLUSD.
That is programmable liquidity in action. You have tokenized treasuries generating real-world yield, and the exact second you need liquid cash to settle a trade, a smart contract automatically swaps it for RLUSD.
No waiting for traditional market hours.
Or T+2 settlement delays. And on the derivative side, Binomial just became the first US CFTC-regulated exchange to accept both RLUSD and XRP as margin collateral.
So traders can hold USD equivalent positions on-chain and use them to margin highly regulated futures and options natively. Okay, so RLUSD is the stable asset you hold to settle accounts within a specific currency zone, like the US dollar zone, without price volatility. But what happens when value needs to cross borders? Stablecoins alone don't solve the Nostro account problem if you still have to pre-fund foreign currencies.
If we connect this to the bigger picture, this is where XRP comes in.
Right.
Stablecoins solve price-stable settlement within a zone. But if you want to move from USD to the Japanese yen or the euro to the Mexican peso, stablecoins still require you to pre-fund accounts in those destination currencies.
They still have that friction.
Exactly. XRP is the high-velocity, low-float neutral bridge asset that moves value between those zones without pre-funding.
And the sources are very clear that this isn't some theoretical future state. The documentation shows that XRP already has 7 verified live entry points directly into the SWIFT messaging network via core banking vendors like Temenos and Volante.
Right. Banks don't even have to build new software.
Exactly. The rails are already integrated into the systems they use every single day to communicate. They can route a transaction through SWIFT, and on the back end, it settles using XRP liquidity.
Which perfectly sets up the SBI Holdings JPY bond experiment detailed in our sources. This is an absolute masterclass in how institutions are adopting XRP.
I really want to spend some time on this because it blew my mind when I read it.
Yes.
SBI Holdings is issuing Japanese yen-denominated security token bonds.
Right.
They act like normal bonds, paying a fixed interest rate of 1.85 to 2.45%. But here's the kicker. They also distribute XRP to the bondholders over time as what they call a side-channel liquidity tool.
Right. And to understand why this is a big deal, you have to understand the yen carry trade. Historically, investors borrow yen at nearly zero interest, convert it to dollars or other assets, and invest it where yields are higher.
They pocket the difference.
Exactly. But the danger of the carry trade is the FX risk.
Foreign exchange risk.
Yes. When you eventually have to pay back that borrowed yen, if the currency valuations have swung against you, say, if the yen strengthens, your profits are completely wiped out just in the conversion process.
Foreign exchange risk terrifies institutions. So how does SBI's bond fix this?
By distributing XRP alongside the yen yield, SBI is creating a synthetic carry trade. The investor is holding XRP, which is a globally mobile, borderless asset. They can mobilize that value anywhere in the world instantly, completely bypassing the friction of SWIFT.
And critically, without doing a traditional FX conversion out of the yen.
Yes, they are extracting value from the Japanese market, but receiving it in a neutral, high-velocity bridge asset.
So they are getting the benefits of the carry trade without the traditional FX exposure. They earn the yield, but the yield is paid out in a globally mobile digital asset.
And more importantly, think about what this does for XRP liquidity on a macro scale. It gradually moves XRP onto institutional balance sheets as a received asset, not a traded one.
It's regulator clean.
Exactly. They didn't go to an offshore crypto exchange to buy it. It was distributed as a yield component of a highly regulated security token bond.
To play devil's advocate for a second, why use a crypto asset for the carry trade at all when you have traditional derivatives to hedge risk?
Because of what happens when the global yen carry trade eventually unwinds. Historically, when that unwind happens, FX markets freeze. Volatility spikes, and cross-border settlement breaks down entirely.
Right.
But these Japanese institutions will already have XRP pre-positioned on their balance sheets. They will have a compliant, portable liquidity voucher ready to go when the traditional rails seize up. They don't need to hedge with derivatives if they already hold the ultimate neutral settlement asset.
That is pre-positioning at a massive scale. It's not about retail speculation, it's about methodically building real, sticky liquidity corridors. They are seeding the global plumbing with the exact asset needed to bridge disparate financial systems, all done quietly and compliantly.
It is a brilliant Trojan horse for institutional liquidity.
So, to summarize the deep dive we've taken today, the global financial system is being choked by the capital drag of legacy Nostro accounts, a pain made acute by Basel III mandates heavily taxing slow, pre-funded capital.
Right, the NSFR requirements.
Exactly. And the retail exchange model of digital assets proved too fragile and risky for institutions, as we saw with FTX. So the solution taking over right now is Digital Prime Brokerage, mirroring the battle-tested structure of the FX markets.
Unbundled and efficient.
By utilizing T+1 netting, give-up models, and pristine collateral legally protected by UCC Article 12 assets like RLUSD and XRP, institutions are stripping away hidden fees and freeing up trillions in trapped capital.
This raises an important question, though, a final thought to leave you with. We've seen how banking vendors and prime brokers are standardizing the settlement layer using smart contracts, like the securitized integration with BlackRock.
Yeah.
If assets, collateral, and netting are all governed by deterministic code and 247 continuous liquidity, will the prime broker of the future even be a traditional financial institution? Or will these entirely unbundled settlement layers eventually be governed autonomously by the network itself, effectively turning the blockchain into a global, automated prime broker that anyone can plug into?
That is a staggering thought to end on. If the network itself becomes the prime broker, the barriers to entry for global finance completely disappear. Thank you for joining us on this deep dive into the source material. Remember to look past the surface-level noise and keep questioning how the world around you actually works.